10-year Treasury yield hitting its highest level in 3 months today as traders look ahead to Friday's jobs print, next week's presidential election, and the upcoming Fed rate cut decision. Here to discuss the implications for the bond market, we want to bring Leland Clemons, founder of fixed income ETF specialist BondBloxx. Leland, it's great to have you here. So let's talk about this move higher, this relentless move higher. It seems like we've seen in yields. We have a sell-off going on in the bond market. So here we are with yields at that 4.3 level. What should investors, or what do investors need to know? Are we likely going to push up against that 4.5 level?
Yeah, I think investors need to remember that rates may have backed up because the economy is strong. Corporate balance sheets are strong. Corporate earnings are strong. When you look at what's happened in the S&P 500 earnings up to Q3, I think we continue to think investors need to lean in to this opportunity, look at corporate bonds as an opportunity for further investment rather than sort of playing into the short-termism of what's happening with rates this week or next week.
When we talk about maybe mitigating the risk, though, in the short term, what is the number one thing that investors need to keep in mind?
Yeah, again, I think investors need to, remember that fixed income is there as a ballast. That monthly income or quarterly income that comes from fixed income, particularly ETFs, can be a real ballast in the face of uncertainty. And I think staying the course, remembering that the economy is strong, is just really important amidst what is inherently going to be over the next few weeks a lot of narrative that can be distracting.
Leland, how much of that, when we talk about the narrative that could be distracting, and we're seeing obviously much of this already being priced in, is it fully priced into the bond market, do you think, at this point?
Yeah, I think what's priced in, again, is a strong economy. We've even looked at corporate balance sheets, interest coverage for U.S. corporations. We feel like things like high yield still offer really attractive yields. The last 9-10 months, things like triple C's have returned somewhere 12%. So investors really have an opportunity to lean into these yields and take advantage of really attractive entry points.
You know, Leland, when we talk about the fight against inflation, a lot of things, I know you're taking a look at the longer term, but we've got to talk about the short term and that volatility. Sure. I guess, how much is that when we take a look at what the market is pricing in or what the market is betting in terms of the fight against inflation, the fact of how much progress the Fed has made, has that been a little bit overextended in the bond market? Yeah,
absolutely. We think traders may have overextended themselves for sure. Perhaps betting on what they want to happen than rather following what is the Fed's been very clear, right? They're going to take a data-driven approach, looking at things like earnings, things like inflation, things like employment, and candidly, the data has come back more positive than I think a lot of traders may have bet. And so investors can look at that again, short term, and certainly, as I said, long term, as an opportunity to capture yield.
You know, you're saying that the biggest driver is ultimately going to be and has been the overall health of the U.S. economy and the resilience that we've seen there. As we look ahead to the next several months and you take a look at the Fed announcements that we're going to get, the election, some of the uncertainties surrounding that, and then, of course, these one-off econ data prints and even earnings, what is the one biggest driver you think for the bond market?
I think the biggest driver, we think the biggest driver for the bond market will, again, continue to be economic data around earnings, around corporate balance sheets, and really that fundamental data that the Fed is looking for. Sure that they'll continue to look at inflation as well, but that's generally been held in check reasonably well. So again, we will continue to look, and we think investors should continue to look at the strength of U.S. corporations.
All right, Leland Clemons, thanks so much for taking the time to join us.
You bet. Thank you.